My name is Mark Cooper. Again, I'm the director of the US Department of Commerce office here in Indianapolis. And my job is to help support Indiana companies in their exporting. You have joined the Indiana District Export Council webinar, Export Lunch and Learn webinar on the Corrupt Practices Act and anti-boycott laws. We are delighted that you joined us today. My role is to facilitate the education of the Indiana export community. We have an office here in Indianapolis. The U.S. Department of Commerce is the frontline trade promotion agency of the United States government. We have offices in both domestic offices in the United States and also offices overseas. Where I say from Argentina to Zimbabwe, we have you covered with U.S. Embassy support. And my job is to work with our Indiana District Export Council to provide programming that will help the export community learn about pertinent export topics. We're delighted that you're here today with us, and we trust that this will be a very informative program, and we hope that you will participate, not just listen, but if you have questions, you can please feel free to put them in the chat. The chat will be moderated, if not by me, by some of my colleagues in my office, Eric Hunt or Scott Lindsay. And without further ado, I'm going to turn the microphone over to the chair of the Indiana District Export Council, Andrew Ranke. Andrew, please take it away.
Thank you, Mark. Thank you for that great introduction. A brief description about us, the Indiana DEC. We're a not-for-profit organization operating under the auspices of the U.S. Department of Commerce. So we work in tandem with Mark Cooper's office here in Indiana. And we're there to promote and support exporting as a way to strengthen Indiana companies, grow the state's economy, and create jobs. We offer one-on-one counseling, workshops, and webinars, and serve as a focal point of export information and resources for companies across the state of Indiana. Each state of the union has at least one district export council. DEC members are volunteer international trade professionals representing the manufacturing, service, academic, and government sectors, all appointed by the U.S. Secretary of Commerce to assist and train small businesses to export. Joining us from the Indiana DEC today are Lloyd Porter from Cook Medical, Bob Mason, Ford Meter Box, Raju Chintala, the India Business Council, also our featured speaker for our September 15th Export Lunch and Learn on India, Colin Rank of the International Center, Rick McNamer of PNC Bank, Joe McMurray, Purdue MEP, and Matthew Levy, certainly from Fager Drinker Law Firm, also one of today's speakers. Thank you as always to our collaborative partners, the U.S. Department of Commerce, the SBA, Exim Bank, IU Cyber, the Indiana SBDC, and the Indy Chamber. This is our fourth Export Lunch and Learn webinar of 2022, and these webinars are offered every other month, beginning in January through November. As Mark mentions, today's presentation will be on Foreign Corrupt Practices Act and anti-boycott provisions, critical parts of export compliance. Accordingly, we've two speakers today. The first will be Joan Akalanu, associate with Fager Drinker, Biddle, and Reith LLP. Joan is a senior business litigation associate in the firm's Chicago office. Her practice, Joan counsels clients through all steps in complex commercial litigation in both federal and state court. As a member of the firm's Foreign Corrupt Practice Act team, Joan also advises and represents clients through FCPA internal investigations and compliance and remediation matters, and represents clients in responding to FCPA related inquiries from the government. Our second speaker to focus on anti-boycott provisions is Matt Levy, also a partner with the law firm Fager Drinker, with a focus on cross-border transactions and international trade. He advises on mergers and acquisitions, joint ventures, corporate reorganizations, export controls, and trade sanctions compliance, and U.S. and foreign antitrust. Matthew presented last year on international distribution agreements, and that webinar is housed at the indianadec.org website. It is an excellent presentation on international distribution agreements. And I recommend those present today listening in, if you have an interest, visit that webinar. Again, it's on our website. With that, I turn the podium over to you, Joan.
Thank you, Andrew. Thank you, Mark. Hopefully everybody can hear me. Good afternoon, everyone. As Andrew mentioned, my name is Joan Akolonu. I'll take a moment right now to share my screen. And so hopefully everybody's able to see the PowerPoint presentation deck. And so as Andrew mentioned, Matthew and I today are going to be presenting on the Foreign Corrupt Practices Act, the FCPA, as well as the anti-boycott laws. So the presentation's agenda really quickly is just that I'm going to start with giving an overview of the FCPA, as well as discussing some compliance strategies and considerations. And then I will turn the presentation over to my colleague, Matthew, who will then present an overview of the anti-boycott laws and some compliance tips. And then we'll leave some time at the end for questions. So I'm starting with an overview of the FCPA. The FCPA, as some of you may know, it's a US law that's applicable worldwide. Specifically, it's a federal US law that prohibits bribery of foreign officials for the purpose of obtaining or retaining business. And then it also requires companies to maintain adequate books and records and internal control programs in their accounting practices in order to prevent and detect unlawful transactions. So in my presentation today, we're both going to be going over the anti-bribery provisions of the FCPA, as well as the accounting provisions. And then in terms of the enforcement agencies that investigate FCPA violations, the US Department of Justice and the Securities and Exchange Commission, the SEC, are the primary agencies that are tasked with enforcing the FCPA. And both agencies take prosecution of allegations of FCPA violations quite seriously. In fact, FCPA prosecutions or enforcement actions that have resulted in settlements have increased significantly in the last decade for both companies and individuals of companies being targeted. So in terms of the FCPA's applicability to those of you that are attending today's training, the FCPA applies to US companies, both public and private, including their subsidiaries in the US or in international countries. So perhaps if your company has a subsidiary in China or Mexico, it would be applicable to those subsidiaries as well as all of their employees, both citizens, resident aliens, and non-US employees in any other country. The FCPA is applicable to large and small US companies alike. I believe given the increasingly global nature of conducting business, if your company in its provision of services or products has any touch points with foreign jurisdictions, so for example, in customs and exporting your goods, or licensing or inspections of your goods, or distributors who may be who are distributing your product or reselling it within foreign jurisdictions, then the FCPA is potentially applicable to you and should be taken into consideration when you're conducting business, when you're onboarding distributors, or hiring agents or other third parties to assist with your business operations in foreign regions. For any of you that are working for US companies that are doing business in foreign countries, you're aware that in some parts of the world, in some jurisdictions, it's still considered quite commonplace or a matter of custom, or that phrase, the way things are done, quote unquote, to provide improper payments or other things of value to government officials in order to get one's products through customs or to win business contracts or other business advantages. Well, whether it is customary or commonplace in foreign jurisdictions, these type of improper payments are considered corruption under the FCPA and are taken very seriously. In fact, the White House last month released a memo identifying corruption as a core national security threat. and expressed an intent to use all its resources to combat corruption here and abroad. And the Department of Justice, the DOJ, also recently announced renewed efforts and focus on combating corruption and working with enforcement agencies in other countries like the UK and France to also investigate and prosecute corruption. So typically, because the FCPA is a statute, people tend to think, oh, okay, that's a legal concern, it's a purely legal matter. But the FCPA is also a business matter and has many implications for how, business operations. First and foremost, because ethics is a core business value, there is definitely a cost, a business cost to corruption, whether that's through investigating it, remediating it, or just in terms of trying to, a culture that, a business culture that promotes corruption. It's cost to train and kind of turn that type of culture around. But then also too, mainly because the FCA violations can have very heavy penalties, monetary penalties, and also very severe collateral consequences. So in addition to, very high monetary penalties in the millions, especially as of recent, FCPA violations can result in reputational damage and market setbacks. And a company's reputation is one of its most important assets, as I'm sure everyone here is well aware. In fact, there's an article in the Journal of Business Ethics that looked at enforcement actions and stock market values between 1978 and 2010 and concluded that stock market penalties to companies that were involved in corporate bribery totaled over $60 billion. So again, there's a great risk of reputational damage from FCPA violations. In addition to that, there's also the concerns of being barred or expelled from conducting business with the federal government. Also, too, FCPA violations have also resulted in exclusions or debarment from conducting further international business, with companies being deemed ineligible to receive export licenses, depending on the level of misconduct and FCPA violation. So first, in terms of going over the anti-bribery provisions, the legal elements of a bribe under the FCPA are first an offer, promise, or authorization that is made corruptly to give anything of value to a foreign official, directly or indirectly, to obtain or retain business of improper advantage. So we're going to go through those elements, the first of which being an offer, promise, or authorization. So under the FCPA, an offer, a promise, or authorization can include, of course, approving a payment. It can include also creating or accepting false invoices, especially without requiring any supporting documentation to verify those invoices. And also it can include relaying email instructions on how to pay. With the relaying email instructions, I also wanted to add that it's not just email. We were just talking earlier this hour about, technology and its impact. And given the fact that, as the DOJ and SEC are well aware, in recent years, there's been an increase of, employees in various companies using social media apps like WhatsApp, WeChat, Jabber to conduct business communications. And so using any of those type of social media apps to either instruct someone to pay or authorize a payment, an improper payment, is also considered to be an offer or a promise or authorization under the FCPA. So as applied corruptly, corrupt intent is often assumed. So just very quickly, it's something that's considered, secretively or surreptitiously. So, especially in instances where employees are conducting business, like red flags for this could be if employees are typically conducting their business communications using one type of medium, for example, email, and then for certain transactions are switching to another medium like text message or these social media apps. Again, that may be a red flag It's not necessarily a definitive sign, but it is a red flag that, you know, something is being conducted secretively or surreptitiously, and perhaps that is an indication of corrupt intent. Also, to obtain something quid pro quo, or doing something that's contrary to local law. We'll be discussing throughout, especially because there's been an increased trend in multi-jurisdictional enforcement of the FCPA, meaning that the US, DOJ, and SEC have more often been collaborating with other enforcement agencies in the UK or France or other countries to combat corruption and to investigate it and prosecute it. It's very important, you know, when you're doing business in other foreign jurisdictions, to be mindful and knowledgeable of the local law in those international markets, to make sure that you're not doing anything that's violating local law. So anything of value. When we hear bribery or improper payments, of course, it's understandable that we would, you know, typically think that that just involves money. However, under the FCPA, bribery can also consist of giving anything of value being exchanged. And so that's not just money. I've listed some examples here, some of which include, you know, non-essential lavish travel expenses, gifts, or entertainment. The gifts, travel, and entertainment has been typically a huge thing within FCPA enforcement actions. For example, Telefonica Brazil in 2019, you know, paid hefty penalties to resolve an FCPA enforcement action for bribing government officials to win business. In that instance, the company was found to have spent $5.1 million to buy World Cup soccer tickets and hospitality for government officials in order to win business. So again, there, it wasn't a cash exchange, but they were buying World Cup tickets, which aren't just any soccer tickets. Also, in terms of, you know, travel for family members of foreign officials. So for example, United Technologies Corporation, they also had to resolve FCPA enforcement action because they were found to have been providing gifts and trips to foreign officials in China, Kuwait, South Korea, and Pakistan in order to win business. Another big one within this list is scholarships and internships. So, you know, hiring family and friends of foreign officials, or hiring just people that the foreign officials have said, okay, we want you to hire XYZ person and have them on your payroll. That also is considered giving something of value to foreign officials. So, for example, Credit Suisse Group in 2018, they had to resolve an FCP enforcement action when they were found to have awarded employment to friends and family of Chinese foreign officials to win banking business. It was actually found that over a 7-year period, that company had hired more than 100 employees at the request of foreign officials. Next, foreign official. So this is a big one in terms of, you know, really issue spotting of who can be considered a foreign official under the FCPA. The FCPA actually defines foreign official quite broadly, and a foreign official can include, you know, any elected or appointed official, even a candidate of a foreign government. It can include any employee of a company owned or controlled by a foreign government. And so it's, again, it's very important to be knowledgeable of the, you know, jurisdiction, the foreign jurisdictions where you're operating in terms of what types of companies are state or government controlled or owned, because some of them aren't, you know, just intuitive. For example, an airline. Panasonic Corporation had to resolve FCPA enforcement allegations because they were found to have bribed a foreign official because they offered a consulting contract to a government official at a state-owned airline. And that then government official used, you know, they paid him in order to influence him to get the airline to give them business. And so because the airline was state-owned, that individual was considered a foreign official under the FCPA. Also another one that isn't quite intuitive is like liquor stores or depots. Bean Suntory, which is spirit-based company that sells alcoholic products, they had to resolve an FCPA enforcement action because they were found to have made improper payments to individuals that worked in liquor stores and depots in India in order to, get licensing for their alcoholic products and to increase their sale orders. Well, in India, these liquor stores and depots were government owned and controlled. And so the individuals that they were making the improper payments to that worked in those stores were considered government officials under the FCPA. And so also too, an employee of an agency or institution run or owned by a government, foreign government can be considered a foreign official. So, research institutions, customs offices, tax authorities. Also another one here, a huge one tends to be, hospitals and clinics that are run or owned by foreign governments. There's been a number of FCPA enforcement actions for companies who were making improper payments to individuals that worked in, state-owned hospitals or government-owned hospitals in China, and in other countries, in Jordan, Lebanon, and other Middle Eastern countries. And then also any political party in a non-US country and any of its officials. I think given, the increase in global negotiations around labor, I think, considering or exploring whether one's negotiations with unions or union leaders, if they would also be considered foreign officials under the FCPA, it's to be mindful of, okay, are these union or union leaders that we're negotiating with, are they also members or heads of political parties, or are they also government officials and thus would be considered a foreign official under the FCPA? So it's just things to be mindful of and take into consideration when, especially given that there tends to be a lot of negotiations now around with employing people in subsidiaries, negotiating with various unions, especially if you're negotiating for employees in like a facility or a factory that's in a foreign jurisdiction. So again, foreign officials can include tax officials, custom officials, court personnel and judges, even office clerks that are in charge of approving permits and licensing for like exporting goods or also inspections of vehicles used to transport goods. If those offices are, government owned or controlled, those clerks can be considered foreign officials.
Hey, Joan,
Mm-hmm.
a question here, because this happens a lot. I put it in the chat, is what's the difference between bribing and facilitating? So facilitation payments, you talked about somebody that holds a license. You're not asking them to give you the license. What if you're saying speed it up?
Yes, so facilitation fees and payments, that's a very good question, Mark. That's understood to not be within, under it wouldn't be considered a bribery or improper payment under the FCPA because it's a natural process that is happening, but you're just, okay, well, the agency or something charges an additional fee to all people if you wanted to facilitate this process quicker. That's something different from, okay, the office clerk has asked me to pay something that isn't a recognized additional fee to not only just facilitate something coming through quicker, but for it to go, like for your goods to go through customs without being inspected, right? Or if there's certain items that are not allowed to be, exported or imported into that foreign jurisdiction, you're paying a fee so that you can circumvent that process and still get those goods in. So that would be what is considered like an improper payment or a bribery. But a facilitation fee, an actual true facilitation fee where it's, okay, this would normally take 3 weeks, but if you, companies that pay an additional fee, you can get it in within 2 weeks, would not be considered, a FCPA violation. But again, in those type of instances where you are paying fees to facilitate a quicker process, documentation is key because, line items like facilitation fee or consulting fee or commissions, those can be red flags because they just, they're very vague in their description. So you want to have documentation that backs up the fact like, okay, yes, this was paid to this individual, and here's the documents that show it actually, they've actually performed the service that they were being paid for, and this is what the service consisted of. Does that answer? I can't, and thank you, Mark, for letting me know because I can't see the chat. So you all can let me know if there's additional questions.
Thank you.
Again, going to directly or indirectly. So, we understand that then improper payments made directly by the company can be considered bribery under the FCPA, but companies should also be mindful that you could be liable for illegal or improper payments that are made by a third party if your company authorized the payment or paid the third party while knowing that there was a high probability that that payment would pass through a government or foreign official. So for example, Polycom, an American communication tech provider, they had to pay the SEC around 10.7 million to resolve FCPA charges involving alleged bribery to Chinese government officials. And in that instance, they were actually providing significant discounts to third-party distributors and resellers, knowing that those third parties would then use those discounts to make payments to Chinese government officials at state-owned agencies. So again, you can be held liable if you're directly making the payment or if you're indirectly authorizing or even paying a third party, knowing that it's very likely they're going to use that payment to then turn around and pay a government official to win or retain business. Also too, failing to investigate third-party risks and ignoring any general and specific red flags. So, failing to conduct any due diligence on third parties because, you're aware that then, oh, well, if we do due diligence, that may flag something that they're doing some kind of suspicious activity. Well, failing to do that due diligence and later it turns out, oh, these third parties were making bribes, your company can also be held liable. So that's why it's key to conduct due diligence, regular and consistent due diligence, and not to ignore red flags that pop up. Again, in terms of the types of third parties that present risk, all types of third parties, which include agents and brokers, there's a lot of FCPA enforcement actions that involve, payments that were made through agents and brokers who then turned around and paid government officials. And not just, the third parties that you yourself, your company hires, but also too, there's been enforcement actions that have indicated that a company is also responsible for conducting due diligence of sub-agents. So any subcontractors that your third parties may be hiring out, it's also key that either if you're not conducting the due diligence, that you have hired third parties that themselves have robust due diligence programs in terms of who they're hiring as subcontractors. Also consultants, distributors is a huge one. There's a lot of enforcement actions involving distributors. So to be mindful in terms of the type of due diligence that you're doing on distributors that your company may hire. Custom brokers, and even joint venture partners. There's been some FCPA enforcement actions that have demonstrated that, as a company, you're responsible for conducting due diligence of even your business partners' agents, when you're working with them collaboratively, like through a joint venture. And then lastly, within the anti-bribery elements of a bribe, it's you're paying or giving something of value to a foreign official in order to obtain or retain business or an improper business advantage. So for example, to avoid or reduce taxes, to avoid or reduce customs duties that you would have to normally pay to get your product within that foreign jurisdiction, to prevent adverse government actions or court decisions. There's been some enforcement actions that have involved, bribery to government officials in order to shut down like customer complaints, or, bribing government officials in order to get their assistance in like shutting down negative media reviews of your product. That again is an improper business advantage, and thus, those payments to the government officials would be considered a bribe under the FCPA. So typically, FCPA enforcement actions that involve, the accounting provisions, which are basically books and records and internal control provisions. Those type of violations are typically tacked on when there's already an anti-bribery violation as well. So for example, a company's been found to have bribed a foreign official to gain an improper business advantage. So typically there's also going to be books and records violation because the company also inaccurately recorded that bribe, right, in its books and records. Or there might be an internal accounting controls violation because the company didn't have a proper internal controls program in place to catch, the fact that improper payments were being made. But in recent years, the SEC has demonstrated a willingness to enforce only books and records and internal control violations, even if there isn't an anti-bribery charge, meaning that, okay, no, they might not have had enough evidence to charge and say, oh, a bribery was definitely made. But there have been some recent enforcement actions where the allegation is, look, we can't prove that a bribe was actually made, but there was enough suspicious activity, and the company didn't have a proper internal controls program to catch it, or B, they had the program in place, but it wasn't actually, you can have something on paper, but it wasn't actually being put into practice. And so the mechanisms in place weren't effective in being able to capture, improper activity that was taking place. So again, the record keeping requirements under the FCPA is basically that the books and the records have to be kept in reasonable detail, so they accurately reflect the company's transactions. And then, any incomplete or inaccurate recordings of transactions is a violation of the record keeping provision. Again, even if no corrupt payment has been found to have been made. And then the internal controls requirement is really maintaining a system of internal accounting controls so that you can reasonably assure that the transactions are being properly reported at your company. Some examples of record-keeping violations are, mischaracterizing payments, such as, recording kickbacks as commissions, or, recording bribes to officials as duties or fees. Again, as I mentioned earlier, a lot of times you'll see vague descriptions like consulting fee, management fee, but there's no real actual description or documentation that demonstrates, well, what were they consulting on? What were they managing? What does that even consist of in terms of what the fee was for? Or entertainment fee expenses being recorded as equipment purchases, for example. Also, like recording payments without proper documentation or first determining the purpose. So that's a huge red flag if there's, payments without any type of backup or supporting documentation. So, invoices are being processed and there's no actual, if it's something involving shipping, there's no bill of lading, there's just no documentation underlining the actual transaction. That's a red flag. Or there's no documentation that confirms that the service that you've hired the people for is actually being done. That's another red flag as well too, in terms of books and records. And then using fake receipts to support a transaction or reimbursement. You know, there's been some investigations that I've been involved in where another red flag is, okay, the company employees themselves are creating invoices for third parties, so third party invoices. And it doesn't necessarily mean that something bad is definitively happening. Again, it's just a red flag as to, well, why is the company itself creating an invoice for a third party? Why isn't it the third party is able to do that for themselves? And in one investigation that I was on, that was happening in terms of like cash payments being given to certain individuals that were helping people's products to get through customs without going, you know, to circumvent the regular custom channels. And so, you know, the company found that some of its employees were creating third-party invoices to cover those payments. And so that was the red flag that sparked the internal FCPA investigation. Some examples of internal control failures are, you know, any payments that are being made contrary to the company's policies. So, you know, there's some instances where there might not be even a policies in place, but also too, just because I think that's an important consideration for businesses to have. It's not simply or merely about, okay, well, we put something in writing, we have a policy, we're good. No, it's about making sure that you have robust policies, that your policies actually are meant to capture and do the things that they say they can do. And so that means, you know, regular auditing or mechanisms like that in place to test and see, well, okay, are our policies actually doing what they're meant to be doing, and are people actually following them? Also, another sign of an internal control failure is payments to a third party without any prior due diligence on that party. Again, there's a lot of enforcement actions that involve the companies not doing any form of due diligence on the third parties that they hired, and those third parties, you know, then engaging in improper payments with government officials. For example, Elbit Imaging Ltd. is an international holding company, and it was found that that company and its subsidiaries paid millions of dollars to a third-party consultant and sales agent for services without knowing if the services were ever being provided. And they failed to implement any kind of sufficient internal accounting controls that would, you know, verify if these payments were being used in the manner in which they had been authorized to be used. And so they weren't brought up for an anti-bribery violation, but this company had to pay penalties for books and records and internal control violations. Additionally, you know, failure to monitor third-party compliance, misuse of petty cash can be examples, and also failure to conduct audits and detect violations. Another company, Kinross Gold Corporation, they're a Canadian-based gold and silver mining company. They also were brought up on books and records and internal control violations because they failed to put into place an anti-corruption compliance program or internal controls for two of their African subsidiaries, despite the fact that they had multiple internal audits that were flagging widespread deficiencies. So again, it's not just enough to say, okay, well, we have policies in place that have us conducting audits, you know, every 2 years on our subsidiaries. It's also about, well, what are you doing with the information that you're receiving back from those audits? If the audits are flagging a lot of deficiencies, what are you putting into place? What is a company putting into place to address those deficiencies? Again, as mentioned earlier in the presentation, it's important, you know, to be mindful of the FCPA, not only because of the potential collateral consequences from violations, but also, you know, FCPA violations can result in very hefty penalties. In recent years, especially, the monetary value of FCPA enforcement settlements has increased significantly. I listed some companies here that, you know, Beam Suntory, which is Chicago-based, they ended up paying 19.6 million to the DOJ and 8.2 million to the SEC to resolve FCPA charges. Stericycle is an Illinois-based medical waste disposal company, and they ended up paying 80.7 million to resolve their FCPA charges. Quad Graphics is a Wisconsin-based print and digital company, and they ended up paying the SEC 10 million. And then World Acceptance Corporation, which is a South Carolina-based consumer company, paid 21.7 million to resolve FCPA offenses involving bribery to Mexican government officials. And I put those down to also just show like there's various industries, companies can be in various industries, but again, if there's touch points with foreign jurisdictions and foreign countries, what people need to be mindful of the FCPA implications. And so then lastly, just in terms of some FCPA compliance strategies, just the importance of emphasizing the need to rely on all your personnel to spot corruption risks in their daily work and respond appropriately. So just emphasizing the importance of complying with all laws and company policies. Again, reiterating, be knowledgeable of those laws in the foreign markets where your business operates. And then also your own company policies should be robust, not static. So it's not enough to just simply, okay, we put a policy in place and we're good. You have to be regularly testing those policies to make sure that they're robust and they're actually addressing the issues that they've been written to address. When in doubt, ask. So again, willful ignorance is not going to prevent an FCPA enforcement action, especially if you're operating in foreign jurisdictions that are typically known to have varying levels of corruption. Then you should be asking these questions. If you know that countries like, for example, Russia or whatnot like that, you should be asking questions because that's a jurisdiction that has been known to have issues with bribery and corruption. Always seek prior approvals of expense where required. So again, expenses should have supporting backup documentation before they're approved. And working with your legal and compliance teams to conduct due diligence on third parties and periodically monitor their compliance. So again, due diligence and monitoring should be conducted periodically and regularly. So not just at the point of onboarding, but like regularly throughout. So maybe every, 2 years or annually or every 2 years or whatnot, but a mechanism should be in place to do it regularly. And then also too, if you hear about or see other red flags, not to ignore them. So really encouraging a speak up or report out culture at your company and business by implementing trainings to make sure that your employees are well versed on the FCPA, and then also too providing various mechanisms that allow for your employees to speak up or report out, whether it's directly to their manager or maybe filling out anonymous ABAC surveys. Because there have been some investigations that I've been involved in that were initiated because of responses that a company received from their anonymous surveys to their employees, and somebody reported like, oh, well, there's been improper payments made to customs officials here in this region where I'm working, and that initiated then an internal investigation. Also, too, some red flags to watch out for, any allegations of unethical conduct, suggestions that laws or company policies don't have to be followed because an unethical conduct is just customary in a country, like those are the way things are done. That's a red flag. The lack of any accuracy or backup documentation to expenses and accounting records. So when there's no, again, backup documentation for invoices, these are huge red flags. Or if you're seeing, regularly paid large round dollar amounts for fees that are vaguely described. Again, consulting fees, commission fees, management fees, and just very large round figures being paid. It's not a definitive thing doesn't mean definitively that something's going wrong, but it's a red flag that people should be aware of. In terms of compliance strategies for third parties, never engage. The big one here I would say is never engage a third party without the required due diligence and approval. Because again, there's been, and I would say a kind of steady increase in the last few years of enforcement actions against companies for the actions and misconduct of their third parties. So it's simply not enough to say, well, this happened at the hands of a third party and not us directly, because a company can still be held liable for what the third party is doing on its behalf. And so it's just key and important to do that due diligence before you approve or hire on a third party or use a third party. Also, compliance provisions must be included in every third party contract. So, the requirement for the third party itself to have FCPA training, for itself to have its own program to conduct due diligence of its subcontractors is key and important as well. In terms of third-party red flags, I think, third parties that are refusing to agree or comply with FCPA or similar laws, that's a huge red flag. Third parties that are reluctant to participate in your due diligence process, again, that's another red flag to be mindful of, and especially because, again, you could be held liable for the misconduct of your third parties. And then also any refusal for them to provide adequate invoices, or if they're offering false invoices, or have unusually high fees and no real documentation to back up, how these unusually high fees are being calculated, or the qualifications or resources that they have to perform these services. That's also a red flag as well. And then lastly, too, in terms of gift travel and entertainment, some compliance strategies to be mindful of on red flags is, giving cash or cash equivalents to government officials. Those are red flags, definitely. Paying for travel that's not directly related to a legitimate business purpose. And then also using fake receipts or other documentation to hide inappropriate gift, travel, and entertainment expenses as well, too. And then right before I hand it over to Matt, I just want to say the key FCPA takeaways is just to remember that there's a broad definition of, foreign official. So to be mindful of that under the FCPA. Also, again, to be careful with any gift, travel, and entertainment expenses involving foreign officials. To conduct meaningful due diligence on any, prospective third party, agent, or broker that's working on your behalf, to watch out for red flags, and to, accurately record and document all your expenses and disbursements, and to report any issues to your legal counsel. And so now I'll turn it over to Matthew.
Great. Thanks so much, Joan. Great job. And thanks so much to the DEC for inviting us to present today. Really happy to be here. Thanks to all of you for joining us to listen in. Joan, let's go ahead and move to the next slide, please. So we're going to switch gears from the FCPA to the anti-boycott laws. You might wonder, when we talk about a boycott, what are we talking about? Generally speaking, we're talking about the Arab League boycott of Israel. So we're talking about other countries out there in the world that maintain a boycott against a particular country or a particular region, which the US government does not support as a policy matter. And so the US maintains these anti-boycott laws essentially to ensure that US companies do not support those unsanctioned boycotts from a commercial perspective. And so again, we're typically talking about the Arab League boycott of Israel. Obviously, we have a very good relationship with Israel, and we don't want to see them isolated politically or commercially. So we talk about anti-boycott laws. There are actually two different sets of laws that we're looking at and thinking about. The first of those is administered by the US Commerce Department, and the law itself is under the Export Administration Regulations, or the EAR, which I'm sure you've heard of before. Generally speaking, the EAR relates to exports of dual-use items, but it also contains a section that deals with anti-boycott regulations. And then the second agency that we think about for anti-boycott is the US Treasury Department. The Internal Revenue Service actually also administers anti-boycott laws under the Internal Revenue Code. It's section 999, which is referred to as the Ribicoff Amendment. Now, what's interesting here is that these two anti-boycott laws, they work together, but they're not always consistent. And so they are applied in different ways. They have some slightly different compliance requirements. And actually, the consequences for violating them are different. So we want to be aware of that. Next slide, please. So let's start with the Commerce Department regulations and talk about what those prohibit. And you can see a list of them here in the bullet points. So you are, as a U.S. company or U.S. person, you are prohibited from agreeing to refuse or actually refusing to do business with Israel, or what's referred to as a blacklisted company, meaning a company or someone else who's been blacklisted by the Arab League. You're also prohibited from agreeing to discriminate or actually discriminating against persons based on their race, religion, sex, national origin, or nationality. You're also prohibited from agreeing to provide or actually providing information about your business relationships with or in Israel or with any companies that are blacklisted by the Arab League. You're prohibited from agreeing to provide or actually provide any information about the race, religion, sex, or national origin of another person. And finally, you're prohibited from signing or agreeing to any letters of credit that might contain those types of boycott terms and conditions. Now, these are the general prohibitions. There are some exceptions that are available to these, but they're very narrowly construed and they can be very complex to apply. So you should just accept that if you get a request to comply with any of these boycotting provisions, that most likely you're not going to be able to comply with those. And just to sort of give you a practical example of what this looks like as these things come up. A few years ago, I was helping a U.S. client negotiate a contract that they were entering into with a party in Bahrain. And it was about a 200, 300-page contract, and buried in the middle was a provision that said things that the U.S. company could not do. And one of the things that it could not do was to provide any goods of Israeli origin or which had any Israeli trademarks or logos. So that is an improper boycott request from the Bahraini party. And so that was something that we had to turn around then, and we had to report that to the U.S. Commerce Department. So that's part of the requirement here is not only if you receive one of these type of boycott requests, you can't comply with it, but you also then have to go and report the fact that you even got that request to the U.S. Commerce Department. And there's a procedure for doing that. You can find it on the Commerce Department website, but there's a process for actually reporting those boycotting requests. Now, what's interesting is under the EAR, if you receive a request to comply generally with a boycotting country's laws, so for example, if your contract says you'll comply with all the laws of Bahrain, that in and of itself is not a reportable boycott request. It's not something you have to worry about, unless it says you will comply with all the laws of Bahrain, including the boycott of Israel. If it has a provision like that, then that does become a boycott request, but just simply agreeing to comply with the laws generally is not in and of itself a reportable request. Next slide, please. So turning to the Treasury Department regulations, the Treasury Department does deny certain tax benefits if you participate in an unsanctioned boycott. So what does participation mean? You're going to see a laundry list here of boycott requests that are similar to what we saw from the U.S. Commerce Department, but they're not identical. So you would be participating in an unsanctioned boycott if you agree to do any of these following things. If you agree to refrain from doing business in Israel or its government or any companies or Israeli nationals, if you agree to refrain from doing business with any U.S. company or other U.S. person that was engaging in trade with Israel or its government or companies or nationals, you would be prohibited from agreeing to refrain to do business with any company who is owned or managed by all or in part, Israelis or people who are Jewish, or if there's any other particular name, nationality, race, or religion, or if you agree to actually remove those persons from management, such as directors of your company, because that's the request you received from a party in the Arab League. You also could not agree to refrain from employing anybody who's Israeli or Jewish or of another particular nationality, race, or religion. Or you can't agree as part of a condition to a sale of products to refrain from shipping or insuring your products with anybody who doesn't participate in the Arab League boycott of Israel. So you can see that those things are similar to what we have as potential boycott requests under the Commerce Department regulations, but they're not identical. And then what's one interesting comparison here is under the Treasury regulations, if you agree generally to comply with a boycotting country's laws, even if there's no specific reference to boycott of Israel, that is considered to be participation in the unsanctioned boycott, and that would be something that you would have to report. So that's a difference with the Commerce Department treatment. And then in terms of how you report to Treasury, you would actually fill out form, I think it's 5713, and that becomes part of your annual tax return. When you file that form with your tax return in order to report to the Treasury Department that you've received that unsanctioned boycott request. Next slide, please. So if you do receive a boycott request, you also have to report to the IRS whether you have any operations, quote unquote, in a boycotting country. We would tend to think of operations, generally speaking, as having a brick and mortar operation in a boycotting country, but it's actually a much broader term than that under the Internal Revenue Code. So operations actually means essentially all types of commercial activities, such as selling products or purchasing products or services, leasing, licensing, all those different kinds of things, essentially any touch point that you would have commercially speaking with a boycotting country. And the Treasury Department puts out a list on a quarterly basis of countries that are considered to be boycotting countries. So as you can see here on the right side, you've got the list for the current quarter, calendar quarter, of all the countries that are considered to be boycotting countries. Next slide, please. So just thinking about what you should be doing as an exporter in order to comply here and ensure you're complying with anti-boycott regulations. First thing is, if you're doing any type of business in the Middle East or in one of those boycotting countries, your radar should go up. You should be thinking about just being sensitive to whether or not you might receive some type of a boycott request. And then you should be watching for red flags. So those are things like any type of a statement or an inquiry regarding the country of origin of the goods that you might be providing to the party with whom you're doing business in the Middle East. You should also be looking for any types of statements or inquiries regarding the nationality of any carrying vessels. So if you see anything that says, well, you can't use a vessel that's got an Israeli flag, that would obviously be a red flag you'd want to be paying attention to. And then if you receive any statements or inquiries regarding the religion or national origin of any persons, be they within the company or outside, you really want to be sensitive to those things. So if you see explicit references to Israel or the word Jewish or blacklisted or any derivation of any of those things, those are red flags that you really want to be careful about, and it may signal to you that you are receiving a boycott request from your counterparty. Please note that boycott requests don't have to be in writing. They can also be verbal. So you may get a verbal request from somebody to comply with the unsanctioned boycott of Israel. And again, refusing to comply with the boycott request is generally speaking mandatory. But again, there's more that's needed than just refusing to comply. Typically, you're going to need to report that request itself, whether you comply or not. You have to report that request oftentimes to both the Commerce Department and to the Treasury Department. And you want to make sure that you retain copies of all documents in which the boycott request is made in case you need to support any of your filings or any inquiries from the federal government. Next slide, please. So just quickly, not to scare anybody, but just to give you a sense of what the penalties are for violations of these laws. You you can see both the Commerce Department and the Treasury Department have both civil penalties and criminal penalties for violations. The civil penalties for the Commerce Department, that they include not only monetary fines, but also as an exporter, you can lose your right to export goods out of the United States, which can obviously be pretty significant to your business. And if you have any export licenses that have been granted, those can be revoked if you don't comply with these laws. And in addition, if there's any type of a willful violation, meaning that you intentionally don't comply either with a reporting obligation or you intentionally agree to help support the boycott of Israel, there are significant fines up to $1 million and even imprisonment up to 20 years. And on the Treasury Department side, the sort of the civil penalty, if you will, is that you can lose your foreign tax credits. So where the U.S. has a tax treaty with one of these boycotting countries, you can have credits, tax credits where you don't end up being taxed twice on the same revenue. You can lose those tax credits, and then any of that revenue you have in the boycotting country can become taxable revenue that you'll have to pay tax on in the United States. And then again, there's also criminal penalties if there's a willful violation. So there are monetary fines as well as the possibility for imprisonment. So I went through that pretty quickly because we're actually over time here. I don't want to keep anybody longer, but we're certainly happy to stay on for a few more minutes and answer any questions you might have, either on the FCPA or on the anti-boycott laws.
Thank you, Matthew, and thank you, Joan, for your presentations. Those were great. It's a good overview. I know that if folks have questions, they can definitely contact you and reach out, and we can refer them to you. But in the interest of giving everybody just a moment or two, if there was a burning question someone had, we offer you can raise your hand or you can open your mic and ask it now for the good of the order.
Matt, I have a question.
Sure.
And I've seen this before, and I want to preface it by saying it was before 2018. But one of the letters of credit we were involved with mentioned that the ship carrying the goods cannot stop at an Israeli port. Is that considered anti-boycott today?
Yes, it is. Generally speaking, if there's a requirement that the ship cannot stop at an Israeli port, then that would be a boycott request. And that's, I think as we went through before, if you see that pop up in a letter of credit, that's one of the types of boycott requests you'd have to report. There are some exceptions, as I mentioned, in some cases, if the country you're importing goods into has an import requirement that talks about not having goods come from Israel in order to get them through customs, that may be an exception. I think you'd want to take a look at the nuances there. But generally speaking, if the letter of credit says you can't have the ship stop in an Israeli port, that would be a boycott request.
Okay.
Hey, Matt, this is Joe McMurray. Perhaps I misunderstood what Andy said, but he said it said Arab ports, not Israeli ports. Does that make a difference?
No, I apologize, Joe. I meant to say it could not stop in a Israeli port, and the ship was headed to an Arab country.
Oh, okay.
But good question, Matt. Does that matter? I mean, say it's reversed. I would imagine it still is.
Well, it wouldn't be part of a boycott issue because there isn't a boycott of any of the Arab countries. So it's really the Arab League's boycott of Israel that we're concerned about.
Yes.
Matt, I just want to ask a quick question on the future of the anti-boycott. We're seeing Saudi Arabia loosen up and others. Do you see discussions on eliminating that eventually because of the, I guess, lessening within the Middle East towards Israel?
Yeah, it's a really good question. I mean, I do think that the political situation is fluid. I guess the way I see that most likely playing out in the near term is that we would probably see the Treasury Department consider removing Saudi Arabia from its quarterly list of boycotting countries. So that might be something we see happen. I don't see the anti-boycott regulations going away more broadly, though, unless there's sort of a broader change that happens within the Arab League to actually stop the entire boycott.
Matthew, Jerry Spoor had a question. Jerry, you want to open your mic?
Am I on?
Yep, you're on.
Okay, thank you. There's a lot being said today, and it all applies to a buy-sell situation. My question is that if you have a transaction, international transaction, to another country, to another vendor, that's a buy-sell, do all of these functions that you just told me, all these regulations apply to that transaction?
So
That's no contracts and all that, just a regular buy-sell. I buy it, I resell the product.
let me make sure I understand. So you're talking about if you as a US company are entering into a buy-sell arrangement with a third party who would then be selling on to someone else? Or are you just asking whether or not if there's no contract in place, do these things still apply?
Example, I have a manufacturing company. I manufacture a product, I sell to another buy-sell person. It happens to be a HEA monitoring thing. I don't know anything about the country laws or anything like that, but we do sell into Saudi Arabia, Qatar, all those places. Have no idea what the regulations are. But if I sell directly to a commercial like any knowing company, where it's Johnson Controls, what it might be, what's the difference between that and one going directly to a local vendor in that, or reseller or contractor in that country?
I see. Okay. So if you're selling directly to somebody in the Middle East and you receive a boycott request, that's obviously something you'd have to not participate in and you'd potentially have to report. If you're selling to someone else, if you receive a request from that someone else, even if they're not in the Middle East, asking you to agree to a boycott with Israel, boycott of Israel, then that is still a boycott request, even if it's not coming from someone in the Middle East. But if you're selling to somebody who's a middleman who's going to sell on to the Middle East and you don't receive any request from them to boycott Israel, then there's no boycott request for you to report. Did I understand the question correctly?
That's clear. That's close. Very close. Thank you.
Yep.
Okay, I want to turn it quickly to the chair of the Indiana District Export Council, Andrew Renke, for any closing comments, please.
Thank you. Thanks, Mark. And thank you to Joan and Matthew. That was excellent. We'll be posting this webinar on our website, and hopefully we'll get a copy of your presentations for distribution to those interested, because this impacts us. I've broached the issue of FCPA over the last 20 years of my exporting career. We had a request we won a tender in Vietnam. The power company that was owned by the government in the contract said we were requesting travel to the United States, which was legitimate, to travel and witness the production facility, look at the production tests and the quality control, installation instructions, lodging. That was fine, but they truly asked us to pay for a trip to both Las Vegas and Disney World on the return trip. So, Joan, you'll be happy to know we said we can't do that. And we would have been written up. We would have been one of those fines, because the company against which we won the tender knew of us, and I think would have found that out. So again, thank you to both of you. That was a wonderful presentation. And September, just a word up, September 15th is our next export webinar, Export Lunch and Learn, and we'll be talking about export opportunities and trade with India. And Raju Chintala on the Indiana District Export Council will be presenting on that, and he's the president of the India Business Council. So India is increasingly a major trading partner with the United States and our state and our country. So, and then October 19th is the Doing Business in Africa seminar in-person event, 11:30 to 6 p.m. at the Hotel Carmichael. So we'll be discussing ways in which we can engage and do business in Africa. I thank you. I thank everyone for participating. Thank you for your time. Sorry, we're a little bit over, but this will be posted on the Indiana DEC website for further reference. Have a great
Thanks everyone for joining. Thank you, Andy, for your comments, and have a good day, everybody. Bye now.